Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Tuesday, the 20th of February, Bull versus webinar. Steve Miley here on the call for Trade Day. Welcome, everyone. So this is our pseudo Monday webinar, right? So we have that slight change in here of format in here. In that we will be doing a look at the shape of the week, as I like to call it. So we'll be taking a look at what's coming up for the balance of this week. Why do we do that? Even though we're trading a day trading at trade day, we do that because it's a good idea to have an idea of the shape of the week, as I like to call it. You know, if you've got a lot of events coming in the second half of the week, then it probably means the first half of the week is going to be less volatile. If it's going to be less volatile, then maybe you might adjust your targets, your stop losses, your expectations about the market for maybe the first part of the week. So let's dive in then. So we're going to start off with just the heads up in here that we do get the we're going to run through not through the macro matters. The macro matters is up. The macro matters is the bigger picture view and the more of an explanation of what happened last week and what we've got coming up this week. So take a look at that if you want to dive in and have some deeper information. That's available both in the fundamental section, which is below the section you've got the technical analysis section below where you're watching this, if you're watching this streaming live, not watching the catch up on YouTube. And if you're watching this on live, or even if you're watching the recording in here, below where you are now, you have three columns. Technical analysis reports, will come to those shortly. The fundamental macro reports, which are put out at the weekend, which includes the macro matters, which is the bigger picture in-depth look, which you're looking at right now, looking back mostly on last week and what we have coming up this week. And then we have the condensed version, which is the weekly recap and update in here, and that's giving us the outlook of what we've got coming up. So last week was obviously we had the CPI report. That was the big driver last week. We chopped lower on that, lower in both bond prices and stock prices. So bond prices went down to lower prices, higher yields, because it was warmer than expected, above forecast. But then stocks managed to rebound, although bonds continued initially to go lower in price. They have actually moved back a little bit higher in price, lower in yield today. Nvidia continues to climb higher in here, hit a new highs in here. Has now overtaken Amazon and Alphabet in market cap. And now is the world's fourth most valuable company. Nikkei, this is not just a US driven rally. The Nikkei hit a multi-decade high above 38,000 mark for the first time since 1990. US CPI, as we said, came in slightly warmer on Tuesday than expected. And markets are now pushed back on Fed rate cut expectations in here, as we've been watching on the CME Fed tool. And there's even and I'll come to the article now, but there is even some hedging going on right now of potential rate, the next move being a rate hike. Can you believe it? A rate hike because of both the warmer inflation numbers and because of the strength of the economy. The economy is not really slowing down. It's very unlikely we're going to get anything like a hard landing. We're getting the softest of soft landings in here, and the economy remains very robust. So there's even, now some very outside chance pricing, and we'll talk about that. There's an article on that. US retail sales were also worse than expected last week as well. So stock indices, global stock indices and US data, US indices in here sold off on the CPI data, but then rebounded. US and European global yields all moved to higher yields. So we had this complete dislocation. We've been talking a lot about this. There was this very high correlation through Q4 of last year for higher bond prices and higher stocks. Higher bond prices, remember, lower yields, anticipation of a pivot by the Fed to more dovish. But this year you've seen yields chopping sideways and actually moving to higher yields, where stocks have continued to go to new all-time highs, as we know. So you've had that dislocation, and that's continued last week in here with bonds. We'll take a look at the bond charts and the equity charts shortly as we move forward. And dollar index on that strong CPI print, that warmer than expected CPI print, means then potentially either not necessarily higher yields, but we have seen higher yields, but de facto a less dovish kind of a de facto less dovish, so a de facto more hawkish stance from the Fed potentially. So that's potentially higher yields, and higher yields are positive for the dollar in here. So the US dollar index surged higher after the CPI, but then has pulled back from the hitting new multi-week highs. Gold futures, remember there's an inverse relationship between the dollar and gold. So gold futures lower to the lower end of a broader range, and oil futures actually went higher to the upper end of a broad range as the underlying positivity around the global economy stays in place, and obviously ongoing Middle Eastern tensions in here keeping oil at the upper end of a broader range. What do we have in here? Well, Asia markets came back going into this week, came back from their Lunar New Year. There's been a easing of monetary policy in China since we've been back over the last 24 hours. We'll talk about that shortly. Yesterday, as you guys in the US will know, it was President's Day holiday. So the futures had a half day, but the cash markets in both bonds and equities stocks were closed yesterday. So a partial day on futures. Going into this week, it's a relatively quiet week, but we've already had this PBOC interest rate decision, which I'll talk about shortly as we move forward. On the data front, the flash PMI data on Wednesday is going to, on Thursday, is going to be we have the flash PMI, I put Wednesday, it's Thursday, and EUCPI also Thursday. They're going to be the main focus points in here. And on the earnings side, we kind of moved away from the earnings season. Most of the earnings season is behind us, but we do have some important data today and tomorrow. So we have Walmart and Home Depot today. And then we get NVIDIA on Wednesday, and we'll talk about those as we move forward now. So looking at the economic calendar, it's a fairly light calendar in here going into today. As we said, Canadian CPI data unlikely to impact the markets you guys are trading, but we should keep an eye on that CPI data out of Canada in just under 1 hour. Obviously, a strong correlation between the US and the Canadian economies, and obviously we had that worse than expected data last week on slightly warmer than expected data on US CPI. So we'll be watching this because there is correlation between a strong correlation between the economies of Canada and the US. With Canada, it's obviously its major trading partner being the US. I think so. It's 78% of trade. The Canadian trade is with the US. If we look at the headlines from LiveScoop on their European briefing, Biden willing to make Speaker Johnson talk Ukraine, Asia, add US, Philippines. $6 trillion wall of cash is holding firm as Fed delays cuts in it. So markets not fully invested in here. And look, investors are paying billions into money market funds by the day with this uncertainty around rate cuts in here. Chinese bank cuts mortgage reference rate by the most on record. So that's what I was talking about there. The PBOC in here, China ramped up support for the troubled property, its biggest ever cut to a key mortgage reference rate. Okay, so this is again, look, the People's Bank of China, it's Tuesday. Chinese lenders slashed the 5-year loan prime rate by 25 basis points. The PBOC announced on Tuesday. So again, in here, we were talking about potentially aid coming in different forms, either monetary or fiscal aid, monetary policy aid or fiscal policy aid in here to the beleaguered Chinese property sector, which is, has underpinned the Chinese economy, and that has continued to come henceforth. And we've had further support in here over the past 24 hours. Moving on then, I just want to touch on the earnings calendar. So we've already had that data from Walmart and Home Depot. You can say green and green in here. So positive data in here this morning. So showing the retailers, those retailers, those US retailers still strong, and US retailers still strong equals the consumer still strong, and the consumer managing to weather through this kind of and create this soft landing. The jobs market stays strong in the US, and the consumer stays strong, and that is being echoed by the retail sector in here with Walmart and Home Depot numbers in here positive in here released already this morning. 5 things you should start your day. Let's take a look through those. So Capital One Financial and Discover Financial are going to combine, not really going to impact us. Credit card murder. This wall of cash, we've already said that in here, $128 billion into money market funds in the US to start 24. Seeing cats futures are pointing to a lower start on Wall Street. So we have dropped lower in here. But obviously we've got that and those Nvidia. That is the really big focus in here. We've already said we've had the Walmart and Home Depot numbers out already. The big focus now, which I did want to go to in here tomorrow, is going to be Nvidia. Okay, remember that's after the bell though, so that's going to be after the close tomorrow evening, Wednesday evening. That's going to be a really big focus for markets in here, being the world's fourth largest company now, bigger than Amazon, bigger than Alphabet/Google. What else? We have Latin America yields. We don't really need to worry about that, and it's a fairly, as we said, Walmart and Home Depot numbers already out in here, and nothing really significant coming out. So there's the Chinese bank cuts key rate by most on record. 5-year loan prime rate down by 0.25% to stimulate the property sector. US stock futures slightly lower in here this morning. Eyes on Nvidia going into tomorrow. European stocks kind of sideways. Miners down lower. Another article on here. Nvidia dethrones Tesla as Wall Street's most traded stock. So used to be that Tesla was the most traded stock. Now Nvidia, the most traded US stock, and China slashes mortgage reference property. So we've already spoken about that already as well in here. So, and then a couple of other points to note then. So UBS now the most bullish of the major global banks, brokers in here, got a year-end target of 5,400. So what's that up? That's about 7 or 8% from now, right? Which is about 5,000 in here, 8% higher from where we are at the moment for UBS's target for year end. They're the most bullish amongst the major investment banks. And here's that article. Look, markets start to speculate if the next Fed move is up there. So interest rate options. So some options. So this is not priced into the futures necessarily, which is effectively what we look at when we look at the CME tool, right? So there's nothing in here. There would be a column here if they were pricing in rate hikes, okay? But the next meeting, March, we've got unchanged. We've got no 550 column in here, right? That would be up 550 to 575. There's no 550 column on the futures at all, okay? But, as this article points out, some of the options, interest rate options, reveal some small hedging for Fed hikes in here. PIMCO sees rising shipping costs as complicating the Fed policy. So rising shipping costs, potential inflation not slowing down. Could the Fed, if the economy stays strong, could the Fed hike? I think it's highly unlikely. But look, in here, perhaps the next shift is in the cut. Former US Treasury Secretary Lawrence Summers on Friday voiced what a number of market participants had already been thinking. There's a meaningful chance the next move is up. So that's on the, potentially thrown in. But no real changes in here. We're not expecting now no chance of really a cut at the March. Now we've got very little chance to look 525 to 550 unchanged, 63% still unchanged in here at the May meeting. And now the bets are really on the June cut. So now only a 20% chart where we're unchanged. So now all bets on a June cut. And if we go to the end of the year, remember, look, here's the high point now. Only 100 basis points down where we are. So looking for 4 rate cuts coming through by the end of the year. And if we go to the November meeting, so we're actually looking potentially for another cut between November and December. So that'd be through the election. Okay, so that's after the election actually, between November and December. I think it's probably the pause is expected before the election, which we discussed last week. Yields have actually just pop this one a bit bigger, but yields in here having had that break higher. There's a CPI break higher. We did retrace that, and now we've been chopping, but we did break out above that 420 level on the 10-year. Got up to so we're back here to the highest point since the beginning of December. In here, we got up to around the 433 level. We have chopped back down lower last week after the initial spurt, higher in yields after CPI, but then moved back higher towards the end of the week. But then this morning, we've retraced lower, backed off from that 433 level. So lower yields this morning, but also lower prices. If we look at the stock indices, a recap through those. Asian stock indices kind of mixed, slight dip on the Nikkei this morning, slightly up on the Hang Seng. You would have hoped to have been a bit higher than the Hang Seng given the rate cut out of China. If we look at European exchanges, kind of unchanged on the day in here, a couple of tenths up and down on the FTSE, UK FTSE and the German DAX, 3/10 up on the French CAC index. And if we look at the US futures in here going into this morning, oh, why is that one not popped out? We saw a slight dip lower in the partial session yesterday. Why is that not opening up? There we go. And if we look, we're a slight dip lower again in here this morning, about 3/10 lower in here this morning. And if we look at my the analysis on the, we have had a bond to say continue to go push down to, this was obviously from last night, but continue the pressures in here to go to lower prices, higher yield on the bond charts, but stocks staying firm. We did get a little bit of a dip in here, back off the highs on the S&P and Nasdaq, but underlying theme remains bullish. And remember, we've got those long-term trend lines in here that come in the S&P comes up from November, and in the Nasdaq it comes up from the October lows, and we're still holding above those trend lines. I'm not going to go into loads of details in here on the charts in here, but let's just quickly in here, and what we'll see in here is we have had these dips back from the highs. Go back onto the daily charts in here, but staying relatively strong. We are back lower in here, but holding way above last week's lows in here. So Nasdaq looking a little bit wobbly in here, just some position squaring, not as negative in here. Look at that 13-day exponential moving average. We went down to that this morning and bouncing off of that. The Nasdaq in here is like now oscillating either side of that, so it's kind of a little bit neutral in here. But for me, the underlying themes, whilst we're above last week's lows, remains bullish. Looking for a rebound from this weakness that we've seen in this morning. But markets in here obviously digesting that news from Home Depot and from Walmart this morning. Also going to be, I think, a little bit tepid, a little bit kind of in consolidation mode ahead of Nvidia's numbers, which we won't get until through midweek, which is tomorrow, after the bell tomorrow. Okay. All right, guys, I'm going to leave it there. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you with another bull versus bear webinar tomorrow on Wednesday.